Welcome back to Talk Tickers. It is Saturday, January 31st, 2026. If you're new here, we are the professional earnings call summary for investors who want the signal without all the noise. I'm your host.
And I'm here to help connect the dots. We are looking under the hood of a regional bank today that I think is a masterclass in how to clean up a messy merger.
That is the perfect way to frame it. Today's deep dive is Beacon Financial Corporation, ticker BCN. They just dropped their Q4 2025 earnings. And for anyone not following this whole saga, Beacon is right in the middle of digesting their big merger of equals with Procline.
Which is never as equal as the press release makes it sound.
Never is. And honestly, this was a critical moment for them, a real check under the hood quarter. It's the first full quarter of combined results.
Yeah.
So the honeymoon is over, the marriage is real,
Mm-hmm.
and the market was watching this one like a hawk.
Absolutely. The stakes were incredibly high. Mergers are usually where value gets destroyed, not created. You've got integration risk, culture clashes.
And just so much noise in the financials.
So much noise. It's hard to see what's really going on.
Well, looking at the tape, the market seems to think they're pulling it off. The call was on the 29th, and the stock popped.
Yeah.
It was up 2.66% to close at 28.93. But here's the thing that jumped out at me immediately. They missed on revenue.
They did.
In this market. Usually you miss the top line. The algos just sell you off before the CFO even finishes speaking. It's a death sentence.
It is.
So what did the smart money see here that the headline scanners missed?
They saw the efficiency. I think the market finally understood that the revenue miss was just noise. It was what we call purchase accounting noise from the merger. It wasn't that the core business is shrinking, it's just that the accounting is messy.
Okay.
So investors focused on the bottom line, on the operating efficiency, and, the fact that management seems to be in control.
Let's get into those numbers then. The headline snapshot. GAAP EPS came in at 64 cents. But, as we always say, during a merger, GAAP it's practically useless.
Completely useless. Full of one-time charges, severance, all that stuff. You have to look at the operating EPS. That hit 79 cents.
So a penny beat against the 78-cent consensus.
The penny beat.
Okay, I have to play devil's advocate here. A 1 cent beat. Is that really something to, get excited about? It feels like a rounding error.
In normal times, maybe. But in the middle of a massive integration, hitting your number or beating it by just a penny is a massive signal of control.
How so?
It means their internal models are working. It means the CFO, Carl Carlson, isn't getting blindsided by hidden costs. Here, stability is the beat.
Fair enough. Stability is the new growth. Now let's go back to that revenue miss. It came in at $225.66 million, about 1.4% below what Wall Street wanted. If the stock went up, something else must have been really, really strong.
It was the margin. This is the single most important metric for a bank right now. Their net interest margin, or INM, expanded to 3.82%.
And that's up 20 basis points from last quarter.
20 basis points.
For the non-bankers listening, why is that such a big deal?
Well, think of NIM as the markup a store puts on its goods. The bank buys money from depositors and sells it as loans. Expanding that margin by 20 basis points means their core profitability engine is getting a lot more efficient. In this rate environment, that's a very, very strong signal.
And the other profitability metrics back that up. Operating ROA was 1.13%. Return on tangible equity, the ROTE, was 13.43%.
Solid numbers. Very respectable for a bank that is essentially still under construction.
And let's not forget the dividend. They confirmed the 32 cents per share quarterly payout.
Which is a hefty yield. At the time of the call, it was around 4.5%.
That puts a nice floor under the stock. It's management saying, we're confident enough in our cash flow to pay you to wait.
Exactly.
Okay, let's pivot to the deep dive. I want to talk about the accounting twist because this is where it gets really technical, but also really fascinating.
You're talking about the early adoption of FASB ASU 2025-08.
Rolls right off the tongue. But seriously, this decision by the CFO drove a huge amount of value. Break this down for us. What did they do?
Okay, so when banks merge, they have to deal with this really weird accounting quirk called the CECL double count on purchased loans. Basically, the rules force them to double reserve against some of the assets they just bought. It makes the loan book look riskier than it is.
And it artificially pushes down their tangible book value.
Precisely. The bank is worth less on paper than in reality just because of a rule. Okay. So FASB, the accounting rule makers, put out a new standard, ASU 2025-08, that fixes this.
And Beacon just decided to adopt it early.
They did, and the impact was not small. It resulted in an immediate equity lift of about $49 million,
Wow.
which works out to a boost of 55 cents per share to their tangible book value. Overnight, the book value of the company went up.
But wait, there's no free lunch in accounting. What did they have to give up to get that boost?
You're right to be skeptical. The trade-off is they have to give up something called accretion income. Specifically, they're losing about $10 to $13 million of pre-tax credit mark accretion every year going forward.
Okay, stop there. Accretion income is real income, right? It shows up on the P&L.
It does, yes.
So they gave up $13 million in future income money that would help them beat earnings next year, just to make their book value look better today. That feels like burning the furniture to heat the house.
It does, but sophisticated investors know that this kind of accretion income is basically a mirage. It's paper income. It's just accounting math. Tangible book value, on the other hand, is real equity. It's the liquidation value of the bank. So they're trading a future illusion for hard reality today.
So it's a move for transparency.
Exactly. And the analysts loved it because it removes the noise.
Speaking of the future, what about the outlook? The CFO said he tracks 6 analysts, and the 2026 EPS range is somewhere between $3.49 and $3.75.
Right, with an average of 362. But it is crucial for listeners to know that's the operating estimate. Management is telling you to ignore the messy Q1 merger charges that are still coming.
Why are there still charges? I thought the merger was done.
The legal merger is done. The operational merger is about to enter the final boss battle.
The dreaded systems conversion.
February 2026. This is the big one.
I feel like every time a bank does a systems conversion, it is a complete disaster.
It often is, and that is the biggest risk hanging over this stock. Management even called it the final exam.
So if they pass this test in February?
The thesis gets a lot cleaner. But because of the timing, those merger charges are going to bleed into the first quarter. Q1 is going to look messy.
Very messy.
But the promise is, once that conversion is done, you get the full realization of cost synergies in Q2. That's when we see what this company can really do.
Okay, so the accounting's cleaner, the merger is almost done. But you can still sink the ship if your loan book is toxic. Which brings us to the elephant in every regional banking room: commercial real estate.
This is where the skeptics always focus. But Beacon is actively shrinking this book. This is a de-risking story. Their investor CRE portfolio is now down to 333% of risk-based capital.
And the target is to get that even lower.
Right. Down to roughly 300% by the end of next year.
How are they doing that without, fire-selling office buildings in downtown Boston?
They aren't. They're doing it the patient way. Paydowns, maturities, but also letting participations roll off.
Let's unpack that. Letting participations roll off, what does that actually mean?
Think of a participation, like a group project for a giant loan. Beacon is on a lot of these deals. Letting it roll off is just polite banker speak for saying, when this contract is up, we're out. We want our cash back.
So it shrinks the bank, but it shrinks the headache.
It shrinks the headache, exactly.
But speaking of headaches, we did see a tick up in non-performing loans, the NPLs. There was one specific $9 million loan that went bad.
Yes. A single $9 million office loan in the Central Business District. A vacancy issue. This is the classic CRE nightmare.
But management didn't seem too panicked. Why not?
Because they were prepared for it. The loan is 56% reserved. They've already set aside more than half the value in cash. And they noted the owner of the building isn't fighting them. They're trying to sell.
It was interesting hearing their color on the Boston market, too. They used the phrase green shoots for life sciences.
Which is a relief. But they were honest that the downtown office towers, the CBD, are still taking some pain.
Yeah, I want to clarify something about provisions. They guided to a quarterly provision of $5 to $9 million, but they gave a specific warning. Charge-offs will likely run ahead of provision. That sounds bad. Aren't you bleeding money then?
It sounds scary, but it's just mechanics. The provision is when you set the money aside. You buy the bucket because you think the roof might leak.
Okay.
The charge-off is when the roof actually leaks and the water hits the bucket. The bad event happened. But you don't need to buy a new bucket. The expense was already taken.
So the reserve balance goes down, but the P&L is safe. It's a sign of the problem being resolved, not getting worse.
Exactly. Critical distinction.
Now, I want to spend a minute on something I think a lot of people glaze over, but it was mind-blowing to me. The payroll fulfillment machine.
Oh, this is fascinating. It's a legacy Berkshire business. Incredibly lucrative, but wildly volatile.
The stats were jaw-dropping. The CFO said deposits could be $600 million one day and $2 billion the next.
Think about that. You wake up with $600 million, by the next afternoon you have $2 billion, because every company just funded payroll. You can't lend that money out. You'd be insolvent by Friday when the cash flows out to the employees.
You absolutely can't touch it.
You can't. So they just park about $500 million at the Fed.
As a buffer.
Purely as a buffer. It's inefficient on paper, but it's the only way to sleep at night.
One last thing before we get to the trade. The capital stack. They have some expensive debt sitting there from Brookline and Berkshire. Are they going to refi?
Eventually. They said they're waiting for a clean quarter. They want to get past this February conversion, show the full power of the synergies in Q2, and then go to the bond market to get a better rate.
Makes sense. And for anyone hoping for share buybacks.
Don't hold your breath.
Yeah, that was a pretty firm no. Capital is precious right now.
Which means they're focused on reshaping the balance sheet, not juicing the stock price.
Okay, we've covered the numbers, the strategy, the accounting. Now it's time for the segment that keeps our compliance officers up at night.
The "this is not financial advice" segment.
Exactly. This is where we pitch a trade that is wild, aggressive, but plausible. What do you have for us today?
I'm calling this one the FASB book value arbitrage.
Ooh, nerdy. I love it. What's the setup?
Okay, so remember, Beacon adopted that new accounting rule, ASU 2025-08. They took a hit to future paper income to instantly boost their tangible book value. They look clean.
Right, their book value is real.
Yeah, but here's the inefficiency. Most of their regional peers have not adopted it yet. So they're still reporting inflated EPS from that accretion income, but their book values are artificially depressed from the CECL double count.
So Beacon looks more expensive on a PE ratio, but cheaper on price to book, while the peers look the opposite.
Exactly. The market is confused by the optics.
So the trade is?
You go long Beacon BCN as the clean book value play, and you short a basket of regional peers who haven't adopted the new standard yet.
You are essentially longing accounting transparency and shorting optical earnings.
Precisely. As those peers eventually adopt the standard, their multiples should compress while Beacon's expands. You're playing the arbitrage of accounting clarity.
That is incredibly high risk. It relies on the market actually caring about accounting nuances, which, let's be honest.
It's a coin flip. The market can stay irrational longer than you can stay solvent.
Disclaimer time. We are just two voices on a show. This is high risk. Do your own research. Please do not trade based on our wild ideas.
Please don't lose your shirt. I don't want the emails.
All right, let's wrap this up. Recap for everyone driving home.
Beacon Financial. A solid operating beat 79 versus 78 cents. Equity got a big boost from smart accounting changes. And the CRE de-risking is actually working despite one ugly headline loan.
And the stock moved up 2.66% because the market is looking forward. It sees the path clearing up after this February systems conversion.
The narrative has shifted from merger execution risk to synergy realization.
And that's the final thought. The next time we talk about Beacon, we'll know if that final exam was a pass or a fail.
Stay curious.
This has been Talk Tickers. We'll see you next earnings season.
Goodbye, everyone.